Good morning, everyone, and thank you for joining us for our quarterly investment briefing session. My name is Tracy, and I'm one of the financial advisors here at O'Brien's. So today's presentation is brought to you by Lonsec, and our speaker today is Ron Mehmet, one of the senior investment consultants at Lonsec. We also have Lisa assisting us with any technical issues today. Please feel free to ask any questions, which we will address at the end of Ron's presentation. And if you have any questions that's in relation to your personal matters, please refer to your financial advisor or contact us from our contact us website. Ron, you can start off.
Good. Thank you. Thank you, Tracy. Good morning, everyone. Welcome to the presentation. I hope this will be helpful for you to give you a better understanding of how we're seeing things that are happening in the marketplace at the moment. So I've titled this Proceed with Caution with the high volatility and the uncertainty that we're seeing this year and potentially next year as well. A bit of disclaimer, as Tracy said, we give general advice, and I'll give you a bit of background on the economics and the outlook and particular segments of financial markets, but anything specific, please go back to Tracy and her team. So on the agenda today, we're going to give a bit of an economic update, particularly inflation, interest rates, the outlook for economic growth, and a little bit about the investment markets and also asset allocation at this point in time. With the asset allocation, you've got to look at it from the point of view, there's a plan that's been set in place, and it is a 5-year view, and it does take into account the ups and downs that we see in markets in the short term, but it is a long-term plan for you. Coming into the economics, as we've all read in the newspapers and heard on TV, inflation has risen sharply. We've basically come out of COVID. People have been basically in hibernation behind, computers and been stuck at home for quite a while. Suddenly, everybody's getting out and about. There's a lot of activity that's occurring. There's a lot of uncertainty because we haven't had one of these events since 100 years ago with what happened with COVID. And as everybody's getting involved in activity, there's been shortages, there's been supply constraints. And as a result of those pressures, we've seen a jump in inflation that's occurred not only in Australia, but worldwide. So showing you on this chart here, what's happened in inflation across Japan, Europe and the US. And I've also put up a chart just to show you now that we have monthly inflation figures just only started this past month. You can see the rise in annual inflation in Australia. And on a monthly basis, we're now up to 7%. And they're figures that we haven't seen in over 40 years. And we also have the quarterly inflation figure. So we're seeing that on a living expenses point of view with the rises that have been in fuel, in food, energy generally, and a lot of our utility bills going up. The problem also is that the issue has been exacerbated by what's been going on in Europe with the Russia-Ukraine situation on the energy side. So that's made it even worse. So the thought was, particularly from the economists and the government officials, were that this year we would start to see a slowdown on the inflation side purely after the post-COVID as people initially ramped up that activity, and then we got back to a sense of normality. But a lot of that is being thrown out the window, particularly with what's happening in Europe on the geopolitical front and the energy concerns and shortages coming into winter for Europe, and they're scrambling for energy, and that's caused the cost of energy and transportation to jump a lot. And we're seeing that coming through in the inflation figures. And with energy, and it transports our goods, we use it to get around. So it feeds into, on a secondary and a tertiary level, into other factors. So when you're buying goods and services, and if they're using transport and it involves energy, whether it's planes, ships, and cars, or trucks, it's going to feed into other areas of the economy. And that's why we're seeing inflation that's risen sharply. And this is why we're seeing governments, and we've also seen central banks react to try and bring this back to more of where inflation should be, their targets for a long term. Again, just to show you another chart of inflation and how swift the rise has been, and you can see the percentage of countries that have been impacted. The chart on the left here is showing you about 80% of countries are now affected with a CPI or an inflation figure that's above where it normally is, around whether it's 2% or below 3% range, or even lower than that. And the chart on the right shows you from COVID through to 2022, how sharply it's risen in the UK, US, and the Eurozone. But you can also see the forecasts of it coming back down, but it's not going to come down straight away. It is going to take probably through 2023 back through to 2024 for it to get back down to, below 2% again. But that means that actions have to be taken in interest rates and monetary policy. I mentioned before about energy and the drivers of it, and you can see here what I said before about LNG or gas prices and oil prices. And you can also see with the issues with Russia, which is the major supplier of gas for heating in mainland Europe, the impact it's had by Russia reducing its gas flows to Europe from February to currently now in September. And it's had a major impact. Just last week, we saw Germany, their producer price, which is their wholesale inflation rate before we get to consumer inflation rate, jumped from 38% to 43%. And all of that is on energy, gas, affecting electricity prices. And this is where governments are talking about in Europe of trying to cap energy prices, because people, do they forego food just to pay for their heating bill? This is the dilemma that's happening in Europe at this stage. And it means that other areas of spending where people might spend on clothes and leisure have to be put one side, because more and more of their money in Europe has been spent on electricity and keeping warm for the up and coming winter months. So it's a real dilemma for Europe. Another one here is on the energy and food. And the impact here is because Ukraine is one of the top 2 wheat producers and sunflower oil in the world, great agricultural area. And a lot of that has had to stop. We've heard about the grain, Russia not allowing the ships to leave the Black Sea and export the wheat and sorghum and sunflower through to Africa and the Middle East. There has been negotiations and there has been some ships leave, but they're relying more and more on other countries like Argentina, Canada, and Australia now to make up that shortage. Okay, it's great for our farmers, but it's cost food inflation to rise significantly, as the left chart shows you, across the world. How much of it? You can see there, emerging markets, 14% food inflation. You can see there the United States up to 8 to 10%. And even the UK and Eurozone, a big jump in food inflation, primarily on wheat and a lot of the other grains that are produced in Ukraine, who's just as big as ourselves for exporting grain to feed people around the world. Now, the other thing that's happened is that we've heard about the shortages of workers in Australia, and it's the same in the United States and a lot of other countries, and the unemployment rates have plunged coming out of post-COVID as people are hiring workers to meet the demand for all the goods and services people want to get that they weren't getting previously during COVID. So you can see how the unemployment rates plunged in Australia down into the 3s. You can see the unemployment rate there, whether it's underemployment, which is part-time people wanting to get full-time work, that's usually been just under 9%, and that's now below 6%. So even the part-timers are finding full-time work. And it's just starting to pick up now on wage price growth. Employers that are not paying their workers more than 1% or 2%, with the rising cost of living, as I showed you before, inflation's jumped, are moving jobs at present going to people who are prepared to pay them a higher wage. And so the turnover in workers has jumped. Now, a lot of people have come back into the workforce, and it's interesting that I saw some figures recently where, yes, people from 18 up to 55 have come back into the workforce. But interestingly, because of COVID, a lot of people over 55 have just left the workforce, and they are the most experienced people that we have. And that's why we've got shortages of engineers, we've got shortages of doctors, we've got shortages of nurses and even teachers, because the people that aren't coming back into the workforce are the most experienced people. And maybe not, they got used to being at home during COVID and decided they just don't want to go back to the workforce for whatever reason. So the participation rate from over 55s has plunged during COVID and has not come back, but the rest of the workforce has come back. Nevertheless, that's caused a shortage, including also where people were on visas coming here for short-term employment, and they left during COVID and went back to the UK, America, back to Asia. They're the ones that the government's now scrambling to try and entice to come back to help with our shortages as well. As a result, wages are starting to rise now and people are changing jobs because of the cost of living pressures. Here's another chart that I've got here just to show you. A lot of people saved up quite a bit of money because they were doing less activities during COVID. So the chart on the left shows you how much excess savings increased during COVID, during 2020 and into 2021. But with the cost of living rising, you can see now that people are having to spend their savings to pay for those bills and the rising food costs and energy costs. And so people are digging into that elevated savings that they had saved up. Now, on the one hand, that's good. On the other hand, that's bad if they're using their savings, because ultimately they're going to run those savings down. And then the worry is, do they start using their credit cards or do they start borrowing money if inflation's allowed to make the cost of living stay this high? Now, the other thing that's happened also, interest rates have jumped as they're trying to tackle this inflation problem. And then on the right-hand side, we've got the central banks that borrowed a lot of the government debt that was issued at the time as budgets went into deficits, and governments handed out a lot of money over COVID to try and help everybody. Now, central banks, what they're doing is all those bonds that they bought off the government, they're actually letting them mature. So all the money that was flooding into the system, or the supply of money, is now being taken back by the central banks. So they issued a lot of money and the government borrowed that money from the central bank by giving them government bonds. Now they're returning those government bonds and they're returning that excess cash back to the central bank. So it also means not only is the price of money going up with interest rates, but the amount of money in the system is also being reduced back to pre-COVID levels. So there's going to be less money washing around in the money market system, as they call it. That's what the chart on the right-hand side is showing. So the balance sheets of the central banks, which have got all these bonds sitting on them, or IOUs for governments going into deficit, is starting to shrink. And as a result of shrinking, what happens is they're sending those maturing bonds back to the government. And in return, the central banks are getting their cash that's in the money system back and destroying it. So they're reducing liquidity, or the supply of money. So items to watch, wages and rents. This is affecting economic growth. The oil price, with winter coming, we don't know how harsh it is. The severity of the winter is going to decide whether Europe goes into a soft, moderate, or severe recession this winter. So energy crisis, what the governments have said in Europe was, if they don't have enough electricity to keep people warm, they're going to shut down mothball factories where people work. So the factories which may go to 3 days a week, or the factories may be shut altogether. So that's going to impact economic growth over in Europe. Starting to talk about interest rates, we've seen interest rates now come down for 40 years, a long, long way from basically the time of Paul Volcker, when he was head of the US Central Bank, the Federal Reserve, and he had an inflation breakout similar to this in the early 1980s to sort out. And we've seen, this is the long bond rate, and it's come down in Australia from where it was up around 15.5%, all the way down. We got down to about 1%. And now we've just seen the breakout of that happening. So it's been a long time since we've had an inflation problem. And when we have an inflation problem, this is what happens. Long-term and short-term rates jump. When we look at short-term rates, We've seen them jump, jump, and jump all this year as the US has tried to tackle, this is the United States money markets. And what they're predicting is they're probably going to go another 0.75% in November. Because they meet every 6 weeks, not like Australia where they meet in the first Tuesday of every month. They're expecting 50 basis points in December and another 25 early next year. So they're talking about their rates probably going up into the mid fours, potentially even higher than that. And what those little dots on the left-hand side is the various voting members of the US Federal Reserve always point out where they think the final target's going to be, or the terminal rate of where they're going to stop hiking rates. And you can see there a number of them have got it around the 4.5 mark. There is somebody around 2.5, 3, but it just shows you how their expectations are that during 2023, they're probably going to stay in the United States up around 4.5 or in the fours, and it'll be 2024 and 2025 before they start edging them down, the rates over there. So that's what the expectations are in the market, that they're going to continue because their economy is still running pretty strongly. To move interest rates from where they were very easy, almost at zero, up to where they've got them now in the US has been taking it from basically easy to neutral. To get to tackle inflation, they need to go for a period of time in restrictive or much higher than neutral, which is regarded at around 2.5%. Neutral cash rate in the US. They probably need, as the dot points are showing, next year, they probably got to stay around the fours and then come down into the threes to try and keep dampening down inflation and get it back under control. Now, this graph is just showing you here, growth has started to slow in the US. Their manufacturing, their orders, and employment in their factories in the United States, 50, where it says 50 is expansion or contraction. So above 50, it was going quite well through 21 and into 22, but you can see the effect now of higher interest rates in the United States just starting to affect exports and new orders at the factory and a little bit of employment. It's still just a little bit below 50 and around neutral level. So it's now starting to have a bit of an impact on manufacturing in the US. Before, when I showed you the savings rate, people were still digging into their savings, still spending the amount what they're spending at the moment. So they haven't actually slowed their spending in the US, the consumer, but the manufacturing side has started to see an impact. On the chart on the right-hand side, this is more in the fixed interest rate market, which shows you the credit ratings for companies. Just like Australia is AAA rated, companies that borrow money from the corporate bond market, they get ratings as well. And it just shows you starting to have an impact now on upgrades or downgrades of the credit ratings of companies that borrow money in the United States. It's now just starting these higher rates to have an impact. Now, this chart that I've put up is for Australia and what the RBA is doing. The one on the left just shows you how fast we've been hiking rates. Now, if you look at the blue line, the light blue line, you could see there that it took us, so the cash rate to get to 3% between 2002 and 2008, we took about 70 months. So it was over 5 years that the RBA slowly ratcheted rates up to 3%. Yet, if you look at the red line, this has all started just in the election month of May. We're now in October, and every single month we've seen a rate hike, and we've seen some severe ones as well. And you can see how the line almost goes straight up in the air for red, which is very similar to the last time we had a series of rate hikes that were very quick in 1994 that happened. So we're almost back to the level of what happened with the yellow line in 1994 in 2022. In 1994, that was a very volatile market, with the share market and the bond market showing absolute negative returns for a year. But once they stopped hiking, the following 2 years, we saw strong positive capital gains in both the share market and also the bond market. You can also see the green line there during the GFC in 2009, 2010, how they did some rate hikes, but not to the same extent. And the chart on the right shows you some of the expectations in other countries. It's a little bit dated now because the UK, given the new Prime Minister and the new government policies there, in the UK, they're talking now about whether the cash rate goes up as high as 5 or 6% over there, and the fall because of the fall in the pound. But you can see generally Canada, US around just high 3s, 4s as the previous chart, and Europe starting from negative up to about 2%. So, and you can see that the charts are showing that that's going to be through into 2023. So they're going to stay up for at least a year or so. Now, I mentioned before that it's a real challenge for households with all the cost of living. In the charts that I showed you earlier, you can see here it's starting to affect consumer sentiment and people concerned about, the rising grocery prices, energy prices, petrol prices. So people are starting to pull their belts in a bit, as the left-hand chart shows. So where before we were up around 100 on, people thinking things are a-okay, things are looking good, that's now plunged to levels that we haven't seen since the GFC. So people are naturally worried, particularly with interest rates going up. If you look at the chart on the right-hand side, you can see we talked about the RBA cash rate going up, but you can see also the effect on 3-year fixed rate mortgage lending, also standard variable rates. Some of the rates now are being shown at 7% to 8% if you want to get an investment loan. You can see home loans are up around 5s to 6s, and you can even see the fixed rate loan getting towards 6% as well. And not, this time last year, you could borrow fixed for 2 or 3 years at 1.89% for a mortgage rate. So going from 1.89% now up into the 6s, it's a huge jump in such a short space of time of 1 year. And that's why the sentiment index for consumers has plunged dramatically. It's going to be very expensive going forward. Now, the people that took out those fixed rates, they're fine, but they're going to be fine if for 2 or 3 years from this time last year. 1 year's gone. Some of them have got 1 year left. Others maybe have, if they're lucky, they've got 2 more years at 1.89. But by the time the fixed rate finishes and they come back into the market and have to decide whether they go to variable or fix again, it's showing you the rates could be 6 or 7% next year for mortgage lending. So that's going to be a big shock to the system next year. Last time we had a worldwide recession was in 2008, 2009. We were the only country in the world that didn't go into recession out of the OECD. The reason being China. China was booming at that time. As a result of them booming, they took a lot of exports. So the export sector saved us from going into recession, but not this time around. China's got its own problems now with the property market being in a downturn and also shutting whole cities due to COVID because they have a no COVID policy over there. As someone was telling me the other day, if one person in a high-rise building gets COVID, everybody in that whole building has to stay home for several days till that person gets over COVID. They have pretty severe requirements for COVID over there. So we're not expecting China. And plus we've had our issues in the past year between our government and their government, which meant that a lot of our exports were no longer going to China. We've had to find other markets. So China is not going to come to the rescue when our economy slows next year like it did in 08, 09. This chart gives you a probability of a recession in the United States. Typically, if short-term interest rates being 2 years in the United States is higher than the 10-year bond rate, that's always been a signal in the past that we're going into recession. So short-term rates higher than long-term, forcing people to borrow short-term. Now, the probability of that shows you right now where the short-term rates in the US are higher than the long-term, and that hasn't happened since the last time the US went into recession. So it's always an indicator about 6 to 12 months ahead that potentially the US is going into recession next year. So here's the economic side. Here's the scenarios. If we get a soft landing, growth will remain positive. Inflation should begin to moderate, and current rates, interest rates will stay about where they are and do enough to curb demand. If they don't, there's the scenarios I've put on there for mild recession and hard landing. At this stage, it looks like Europe's going to be between a mild recession and a hard landing, and the United States is between a soft landing and a mild. At the moment, we're still in the soft landing stage because things are going to be difficult here on the home front. But again, we're still exporting a lot of our raw materials, particularly we're actually sending our gas now to help Europe out, and it's not going up to Japan, Taiwan and Korea. So we're diverting our gas to help Europe. And in return, we're sending now coal up to North Asia as a substitute for gas. What that means is that our balance of payments has gone from a positive of about 2 billion up to 17 billion. So it may be that all the exporting that we do, plus all the high wheat prices, because Ukraine's not available to use their agricultural land, we might actually see an export boom continue for another year for our farmers, particularly with the wet weather allowing them to sow a lot more grains, and we get some really good income coming into our farmers and our miners, which may mean we get a soft landing rather than go into recession. So these are the scenarios, these are the outlooks that people are looking at as they see the data right at this point in time. If I move on to Lonsec, we do a bit of dynamic asset allocation, which is tweaking the long-term models that we use for investing. And at the moment, given the share market's been down this year because of higher interest rates, and we've seen a lot of investors now rotate from growth companies back to companies that have got more certainty with their earnings, and also companies that have earnings that are protected by inflation. Typically, that might be infrastructural, like tollways, where every time the CPI goes up, the tolls go up, unfortunately. Those type of companies have a consistent dividend income stream. So there's been a rotation to more certainty of dividends and income from shares rather than being in the high growth ones. The business cycle is moderating and bond valuations look more attractive. We've actually seen this year where short-term and long-term interest rates have gone up from record lows during the COVID period, from around below 1%, now up to 3 or 4%. Now that's showing a mark-to-market loss of like 10% on fixed income, and you very rarely see paper losses on fixed income. But the thing is, if the bonds don't go into default, so we're talking here Australian government, the Victorian or New South Wales government bonds, and the major banks, very unlikely they're going to go into trouble, any of those people. So those bonds which are showing up as 95 and 96 cents in the dollar, at maturity, they will go back to 100 cents in the dollar. But what will happen is the fixed income managers will now go back, and now instead of having to buy bonds at 99 cents in the dollar, they'll now be able to buy them at 95 and 94 cents in the dollar and get you a higher income or higher running yield on the bonds. So before, when the bonds were less than 1%, you weren't getting much of an income. Now we're seeing 4 and 5% on the bonds. So there's a lot more income, plus they're buying them at a cheaper rate, and they go back to maturity, unlike shares, 100 cents a dollar. So you're picking up a decent capital gain and a decent income from bonds going forward. So where we might see at the moment, mark to market minus 10%, the next couple of years, you're going to see some high single digit returns coming back into fixed income. Just coming to where we're positioning the funds, where we're tweaking the funds at the moment. We have gone slightly underweight in recent times in global equities because of the downturn. We're seeing earnings get downgraded and dividends cut overseas. We're still maintaining our Aussie position at neutral. What we've done is we've gone back into Australian bonds, and Australian bonds are back to neutral. We're keeping some powder dry in cash. Infrastructure is going really well because it's inflation protected, predominantly inflation protected, but we have been trimming riskier assets in the past 6 months in our positioning. So when we look at the market overall, short-term interest rates are going to continue to go higher in the near term. Yes, we saw this week how the Reserve Bank only raised by 0.25%, which gave a real fillip the last couple of days of the share market instead of another 0.5%, which tells us we're getting much closer to the end of the rate hike cycle. But that'll be data dependent. If inflation remains resilient and doesn't get back to where the RBA wants it, between 2 and 3%, they will keep going with hiking rates. We're seeing a divergence in different equity share market sectors. People are now rotating away from companies that have affected their margins by the rising cost pressures to companies that have got better cost pressures under control and also have inflation protection. Tail risks remain. That's the geopolitical side. You know, we don't know what's going to come out of left field, particularly with what's going on with Russia and the Ukraine and threats of nuclear weapons. So that's always something on the left-hand side that we keep watching, as they say. Macro factors, which the economics and the sentiment in the short term is negative because rates are still rising. It's impacting people's cost of living and inflationary pressures. We're waiting for them to start slowing down. And we actually seen some of that in the petrol pump where we had $2.40 a litre. Yes, it got down to $1.60, $1.80 for a short period. It's back up to $2.08, $2.09. So there is an amount of easing in the energy side, and we just need Europe to try and get through winter. And hopefully winter isn't severe, and we might start to see those energy prices start to ease as Europe finds alternatives to getting gas from Russia. So investment selection is quite critical at the moment. And the other thing is portfolio diversification is paramount. You need to have a good spread of different investments because you never know what's going to come out of left field and upset financial markets for a short period of time. We try to focus on the 5-year outlook, and we always put a plan in place for our clients for 5 years, but we will dial up and dial down the amount of risk in the portfolio depending on what the economic circumstances look like over the next year or two. And there's the last chart to focus on long-term returns. I put this in because when I first started in financial markets after I finished uni, in one of my first jobs, I saw the share market crash in 1987. And I'd just come up to Sydney then from country New South Wales. We came in on the day of the share market crash, and our boss says to us, look, we haven't had a share market crash since 1929. You'll never see another one for another 60 years. So for morning tea, he sent us all down to Bond Street and to see a share market crash because he says we'll never see another one in our lifetime. But aside from that, if you look at this chart, there's always something that's coming out of left field to upset financial markets and get people watching the news. We saw, from the Vietnam War, the Korean War, OPEC, 2001, the September attacks, the tech wreck in 2000. We saw the global financial crisis in 2008. 2012, we had the European debt crisis, and then more recently, the 1 in 100 year event with the outbreak of COVID, which we haven't had since the Spanish flu and World War I, which happens once every 100 years or so. So you just got to remember that every so often there is going to be something that goes and upsets the markets and causes volatility. But if you stick to your long term, it shows you the share market still goes up over the very, very long term, but it doesn't go up in a straight line. There is going to be short-term ups and downs. The classic there is seeing the 87 crash. You can see there, at the time when it happened, I remember the market was down 25%. But when you look over the long term, it comes out as a blip. So even the global financial crisis, you can see that as well as a blip. So yes, we do get volatility in markets, But if you stick to your long-term plan, and yes, you do a little bit of tweaking along the way, over the long term, it still rises. And I'll leave it at that and go back to Tracy and say thank you for having me on, and I'm happy to take any questions from anybody.
Sorry, thanks, Ron, and that was a great presentation. Sorry, I still had myself on mute there. So we don't have any questions from the participants or the attendees today, but I just had a couple of questions for you.
Yep.
So on the labour market, we understand that it is currently a bit tight, and mainly due to the factors that you've already mentioned.
Yep.
But are there any expectations for the people that's over the ages of 50 to come back to the labour market, especially with the cost of living, rising?
Yeah, there absolutely there is. There are employers out there that are taking on people on contracts or short-term or part-time work. So there is a lot of companies out there that are dying for people with experience that can come and help them in the short term to get over this, because the government at the moment is trying to get about 350,000 people back into Australia on short-term visas to assist. That was about the number of people that left during COVID. So the government's trying at the moment get those visas out. And in the meantime, they're also asking people that are over 55 to please come back to the workforce and help out, whether it's in nursing, doctors, engineering, any type of work to get us through the labour shortages. So if people want some additional work, it's out there for them right now.
It's good to hear that there's a plan in place. Maybe they can put some incentives in there for the over 55s to come back.
Absolutely.
And another question is that I know you gave us an update around bonds. So would you still say bonds would still be considered a safe or a secure investments, considering the drop that did happen in the last 12 months?
Yeah. As I said, the only issue happens with bonds is if they default. So the person who issues the bonds doesn't make payments to the investors. Most of the bonds in Australia are high quality. They're issued by the Commonwealth Government, the state governments, the major banks. The corporate bond market in Australia, 2/3 of the bonds are issued by the major banks. So the rest of the corporates usually go for bank lending in Australia. Some of them do go to the corporate bond market. But at this stage, it's pretty high quality and it's all investment grade predominantly in Australia. So that's BBB rating or above. The only area of concern is in the property market, the real estate market, particularly with property developers. That type of stuff is not generally where investors go into or fund managers go into investing. They mostly go into the corporate bond market. So yes, as I said before, they're not buying the bonds at 99 cents in the dollar, because the whole yield curve, whether it's the bond market or the RBA cash rate, has now risen from record lows. We're starting to get back to normality. They're now able to buy those bonds in the marketplace at 95 and 94 cents in the dollar, or effectively a 5 or 6% yield. And then if it's a 5-year bond or a 3-year bond, it goes back to maturity at 100 cents in the dollar. So you pick up the capital gain and you still get your quarterly coupon payments or 6 monthly coupon payments from them. So there is no issue with those bonds. As I said, the only risk is if it's a bond that doesn't make a payment, which is very unlikely in our market. This is very different to the United States market, where a lot of their bonds are what they call the high yield or the junk bond market, and they're graded below BBB. They're a different market to us in that companies more likely they go to the bond market to borrow money rather than they go to a bank. Mostly it's the consumers in the US. But the type of companies over in the States, aside from their really big companies, the smaller ones also go to the bond market, but they're a much lower credit rating and they have a greater than 1% chance of defaulting over there. So there is a bit more risk in the corporate bond market in the US. But we're talking about default rates which have been less than 1%. Historically, they're 4 or 5. They're only predicting that to go up a couple of percent in the United States at this stage. So if we have a soft landing or a mild recession, it's unlikely that the default rate in the United States will go up a lot.
Great. Thank you for your explanation there and for your time today. And we want to thank Lonsec for partnering with us today for this session as well. Thank you so much for all those who attended this session. And also there'll be a recording that will be shared to all participants today. Thank you so much for attending.
Thank you very much.
Yeah, bye.
All the best. Bye-bye.